Dollar cost averaging versus lump sum investing. One builds more wealth. Here's what the data says. Most people think investing a little each month is safer than investing a large sum all at once. But the data tells a different story. Lump sum investing outperforms dollar cost averaging about 2/3 of the time because markets trend upward over time. The longer your money sits on the sidelines, the more growth you miss. Today I'm breaking down both strategies, showing you the math, explaining the psychology behind each, and revealing when each one makes sense so you can maximize your returns. What is dollar cost averaging? Dollar cost averaging (DCA) means investing a fixed amount of money at regular intervals, weekly, monthly, or quarterly, regardless of market conditions. How it works: let's say you have $12,000 to invest. Instead of investing it all at once, you invest $1,000 per month for 12 months. When the market is high, your 1,000 buys fewer shares. When the market dips, your 1,000 buys more shares. Over time, you average out your purchase price. The appeal: DCA feels safer. You're not trying to time the market. You're spreading risk. If the market crashes right after you invest your first 1,000, you still have 11,000 waiting to buy at lower prices. The problem: while you're spreading your investments over 12 months, your money sits in cash earning little to nothing. If the market goes up during those 12 months, which it does about 70% of the time, you miss those gains. What is lump sum investing? Lump sum investing means investing all your money at once instead of spreading it out over time. How it works: you have $12,000. You invest all $12,000 today into your chosen index fund or portfolio. The appeal: your money starts working immediately. You capture every day of market growth. If the market averages 10% annual returns and you invest a lump sum on January 1st, you get a full year of growth. The problem: if the market drops right after you invest, you experience an immediate loss. Psychologically, this is hard. You see your 12,000 drop to 11,000 or 10,000, and you panic. The data: lump sum wins 2/3 of the time. Vanguard conducted a study comparing lump sum investing versus dollar cost averaging over rolling 10-year periods in the US, UK, and Australian markets. The result: lump sum investing outperformed DCA about 66% of the time. Why? Because markets trend upward over time. The S&P 500 has been positive in about 75% of all years since 1928. If you delay investing, you're more likely to miss gains than avoid losses. Let's run the math. Scenario 1. Lump sum investing: you invest $12,000 on January 1st. The market returns 10% for the year. By December 31st, you have $13,200. Scenario 2. Dollar cost averaging: you invest $1,000 per month for 12 months. The market returns 10% for the year, but your average time in the market is 6 months, since you're spreading investments throughout the year. Your average return is closer to 5% because half your money wasn't invested for the full year. By December 31st, you have about $12,600. Lump sum wins by $600 in this scenario. Over decades, that gap compounds into tens of thousands of dollars. When dollar cost averaging makes sense even though lump sum investing wins most of the time, there are situations where DCA is the smarter choice. Situation 1. You don't have a lump sum. If you're investing from your paycheck, you don't have a choice. You invest as you earn. This is the most common form of DCA, and it's perfectly fine. You're building wealth consistently. Situation 2. You're emotionally uncomfortable investing a lump sum. If investing $12,000 all at once keeps you awake at night, DCA gives you peace of mind. It's better to invest slowly than to not invest at all because you're paralyzed by fear. Situation 3. The market is at all-time highs and you're nervous. If the market has been rallying for years and you're worried about a correction, DCA lets you ease in without the anxiety of investing everything at the peak. But here's the catch: all-time highs are normal. The market hits new highs regularly because it trends upward. Waiting for a crash often means waiting forever and missing years of growth. Situation 4. You're new to investing and learning. If you've never invested before, starting with smaller amounts helps you learn without risking everything at once. As you gain confidence, you can increase your contributions. For a comprehensive guide to building wealth through discipline, long-term investing, check out The Intelligent Investor by Benjamin Graham. It's the book Warren Buffett credits with shaping his investment philosophy. Links in the description. When lump sum investing makes sense. Situation 1. You have cash sitting idle. If you have $10,000, $50,000, or more sitting in a savings account earning 2% while inflation is 3%, you're losing purchasing power every year. Investing. Situation 2. You receive a windfall. Inheritance, bonus, tax refund, severance package. If you suddenly have a large sum, lump sum investing gets that money working immediately. Situation 3. You're comfortable with short-term volatility. If you understand that markets fluctuate and you're not going to panic sell during a downturn, lump sum investing maximizes your long-term growth. Situation 4. You're investing for the long term. If your time horizon is 10, 20, or 30 years, short-term market swings don't matter. Lump sum investing gives you the most time in the market, which is what drives compound growth. The psychology: why DCA feels safer even though the data favors lump sum investing. DCA is psychologically easier for most people. Why? Regret aversion. If you invest a lump sum and the market crashes the next week, you'll regret not waiting. DCA spreads that risk and reduces regret. Loss aversion. Humans feel losses more intensely than gains. Losing $5,000 hurts more than gaining $5,000 feels good. DCA minimizes the pain of immediate losses, the illusion of control. DCA makes you feel like you're managing risk and timing the market, even though you're not. It's comforting. But here's the reality: your feelings don't change the math. Lump sum investing wins more often because time in the market beats timing the market. The hybrid approach: lump sum over a short period if you're uncomfortable with full lump sum investing, but you don't want to spread it over a year. Consider a hybrid approach. Invest your lump sum over 3 to 6 months. Instead of investing $12,000 all at once or spreading it over 12 months, invest $4,000 per month for 3 months or $2,000 per month for 6 months. This gives you most of the benefits of lump sum investing. You're in the market quickly, while reducing the psychological discomfort of going all in immediately. Studies show that shorter DCA periods, 3 to 6 months, perform nearly as well as immediate lump sum investing while being easier to stomach emotionally. What about market crashes? The biggest fear with lump sum investing is this: what if I invest everything right before a crash? Let's address it with real data. Scenario: you invested a lump sum in January 2008, right before the financial crisis. The market crashed 40% over the next year. Your $12,000 dropped to $7,200. That's painful, but if you held and didn't sell by 2013, your investment recovered and was worth about $15,000. By 2020, it was worth $30,000. By 2024, it was worth over $40,000. Even if you invested at the worst possible time, right before a crash, holding long-term still produced significant gains. Compare that to DCA during the same period. If you spread your $12,000 over 12 months starting in January 2008, you'd have bought at lower prices during the crash, which feels better. But by 2024, Your investment would be worth slightly less than the lump sum investor because you had less money working during the recovery. Lump sum still wins even through a crash because you had more time in the market. For strategies on staying disciplined during market volatility and building long-term wealth, read Money, Master the Game by Tony Robbins. It covers how billionaires think about investing and risk. Links in the description. The real question, what are you doing with the cash? The biggest mistake people make isn't choosing DCA over lump sum. It's leaving cash uninvested while they wait for the right time. If you're sitting on $20,000 in a savings account earning 2%, waiting for a market correction, you're losing money to inflation and missing growth. The opportunity cost of waiting. Let's say you wait 2 years for a crash that never comes. The market goes up 20% during those 2 years. You avoided risk, but you missed $4,000 in gains. When the market finally dips 10%, you invest, but you're still behind where you would have been if you'd invested 2 years ago. Waiting costs more than investing. Your next move, if you have a lump sum sitting in cash, decide this week whether you're investing it all at once or spreading it over 3 to 6 months. If you're uncomfortable with full lump sum, use the hybrid approach. Invest 1/3 now, 1/3 in 30 days, and 1/3 in 60 days. You're in the market quickly, but the gradual entry reduces anxiety. If you're investing from your paycheck, keep doing what you're doing. Automate your contributions and let DCA work naturally. The worst thing you can do is let fear keep your money on the sidelines. Time in the market beats timing the market. The sooner you invest, the sooner your money starts compounding. That's Wealth Mode. If this video was helpful, please click the subscribe button and then like and share with your family and friends.